Let's talk about the formation documents of an LLC and a corporation.
This is our first episode of business school.
Sweet.
I can't wait. Previously, we've done some content on personal finance as a way to help out our audience members, help you get a handle on finance, pursue financial freedom so you can do the things that you want to do with your money, and importantly, time. So if you haven't checked that out, go over to our YouTube channel and check the personal finance playlist. We've got some good stuff happening in that, I think. We've talked on the podcast about, helping people learn how to analyze deals so that they can approach their investments with a little bit of knowledge in their pocket. So one of the ways we're going to do that is by doing some information in business school.
Okay. When you are analyzing a deal, just jump right in there, right?
Great.
When you're analyzing a deal, one of the things that you will be looking at is the entity. So you want to determine, is it a corporation or an LLC? Now, I only give those two as examples because in the crowdfunding law, corporations are not allowed. As in, it's right in the rules, and it's because there are types. There's a restriction in the law for an S corp that there cannot be multiple classes of interest. But in a regulation crowdfunding, there almost always is. That's one thing. And there's also problems with the number of investors. So you're limited typically in an S corp to, I think it was 100 investors, and very regularly in crowdfunding you're going to
have a lot.
Have more than that. A crowd of them.
A crowd, say.
So, and almost nobody uses partnerships right now. Now, I say that from the perspective of being an attorney and helping a lot of companies form. Most people wanted to be an LLC because it kind of combined some of the protections of a corporation and then the partnership structure of a partnership and combines them together. So,
can we pause and talk about the benefits of a partnership structure? I don't know why that is particularly appealing to people.
Well, it's in a sense, if two people start doing business together, let's say they have no agreement, they just start doing business, they have a partnership by law. So it's, in a sense, you would argue that it's more simplistic than a corporation, which requires you to, for example, have annual meetings and take notes. And if you don't do those things, you could get into a position where the owners of the company no longer have protection from liability.
Okay.
Which is, so there's a lot of formalities in a corporation that don't exist in a partnership.
Got it.
And that is carried over to the idea of an LLC where you do not have to have annual meetings. Now, some people would be like, look, our company does our annual meetings in vacation places like Hawaii or whatever, so I want it to be a corporation. Great, do that.
Love that for you.
And in a partnership, there are tax benefits, which those are carried through to the LLC as well. Okay. As long as they're taxed as a partnership, which is typically the default. You can choose when you're an LLC to be taxed as a corporation, and there are some times where that is better.
Like crowdfunding.
Yeah. The reason why is because a lot of companies are not going to be making distributions, and they don't want to have to file tax paperwork for all owners.
So if an LLC crowdfunds, but they elect to be taxed as a corporation, they don't have to give tax documents to all the investors unless there's a distribution.
Right. And again, that may never happen in some of these investments. So
sweet.
Yeah. Okay, going through, I'll just say, let's talk about the formation documents of an LLC and a corporation. So in an LLC, you have to file some document with the state to be created. And typically the name of that is going to be articles of organization or certificate of organization. And it depends on what state you're in. It changes, the state determines what that's called. But the idea is you file one document with the state and then you technically exist. You you will want, in almost every case, to have an operating agreement. And the operating agreement is the rules by which the owners of the company interact. Mm-hmm. And so it says who's in charge. It says how you vote on changes, mm-hmm. and how you bring other investors in. And so those, I'm going to say that those are the main things. It also talks about your tax status. Mm-hmm. With a corporation, you're going to file what is called articles of incorporation. That's almost true across the board, mm-hmm. in all the states. The articles of incorporation identify a bunch of those rules. Mm-hmm. Really, it's almost always the rights of the owners and rules of the business.
Okay.
Now, they also have bylaws, which also include rules. It typically does not have. It's typically the organization management of the company, mm-hmm. in the bylaws, and then in the articles, it's going to be the ownership benefits. Okay. So if you have multiple classes of owners, you can put that in the articles of incorporation, what the rights are of each of those. Now, you can have a shareholders agreement where certain classes of investors come in on certain terms, and they're outlined in the agreement, mm-hmm. this shareholders agreement. There are a few documents that are kind of technicalities. Mm-hmm. Again, like I spoke about, the reasons someone might want to be an LLC is, mm-hmm. the formalities. Yeah. With a corporation, you have to appoint a board of directors, mm-hmm. and the board of directors has to appoint officers. Mm-hmm. And there are certain things that have to be approved by the board of directors. Okay. So like if you want to issue more shares or issue new class of shares, mm-hmm. or enter into a merger or acquisition type agreement, or anyway, for those types of deals, you have to get board approval first, and they have to sign a document that outlines what they've agreed to, mm-hmm. what they've approved. And so anyway, you'll have one set of documents saying who the managers are, mm-hmm. The board of directors are, mm-hmm. and then another document saying what things have been approved in general.
Okay. And do those have specific names, or they just depend on?
So it's typically something like written action by the board of directors.
Very fancy.
Or written action by the organizer, which that's the one that appoints the board of directors, the initial board of directors.
Okay. Cool.
Yeah.
Let me ask you this.
What questions you have?
Why Delaware? And also explain the context of the question.
Okay, so with a lot of startup companies, and when they go to get investment from a venture capital group, they will be forced to change their organizational structure to Delaware if it is not Delaware already. That is not always true. I've been in deals where someone had an LLC in Utah, yeah. and the investment group did not care. Mm-hmm. They went forward with that.
And when you say organized with Delaware, like they have to file with the state of Delaware so that right?
Yeah. Most people will just think, they're just thinking, hey, I'm starting this business, I'm going to form it in the state that I live in, and that seems obvious. Mm-hmm. And so why would they think otherwise? But there's a lot of information out there that says, no, you should form in Delaware. Mm-hmm. Now, let's say that, so we're here in Missouri. If we started a company and we're going to shoot for venture capital investment, we form it in Delaware, we would then get it authorized to do business in Missouri. Mm-hmm. So there's filings in both states. But the reason why traditionally the venture capitalists will require it to be in Delaware is that the court in Delaware is very developed, has mm-hmm. a special court called the Chancery Court, and they only do business litigation. And so those judges are more versed. So, and there is a set of laws mm-hmm. as well that are more defined for what rules exist in company disputes. Mm-hmm. And so the combination of those things gives a lot of assurance to people that they can understand, because of past experience, what rules they're going to be playing into if the entity is a Delaware company.
Got it.
So now, I will say this: some states have tried to mimic Delaware mm-hmm. and have a chancery court, mm-hmm. A specific court for that, and have laws that are favorable and well enumerated and mm-hmm. things like that. And so Delaware has competition. Again, to some degree, it's a dogma. It's this spread belief that everybody says, and so everybody believes because everybody says. And at the same time, I have seen deals go through where that didn't it wasn't required.
Yeah.
And so that's why I'm like, okay, it's not always true. And people are like, oh, it has to be a corporation. I'm like, I've seen it be an LLC. And some people want the tax benefits of getting a write-off on losses that they're anticipating.
Which is through the LLC?
Yeah, so in an LLC, the typical partnership taxation structure is that the losses or the gains go through to the owners, and then the owners claim those losses or gains on their taxes. So let's say you have you're anticipating a ton of income from one source. You can invest in this, startup company that is anticipating at the beginning having a lot of losses, and you take those losses, and now you don't owe taxes or less taxes. And so there's, yeah, it's like, well, when your income gets that high, like, then you can worry about it. But anyway, so it doesn't matter for a lot of retail investors. It's not gonna, it actually might be more of a hassle for you as a retail investor if you are looking at an LLC, because if you start getting these K1 statements from companies, you're gonna have, if you don't already have an accountant doing your taxes, you're probably gonna wanna hire one at that point. And that may be like the whole entire, that cost might be the same as the amount of money you invested in one of these small companies. So why would you want to
make $250, spent it on a CPA?
Yeah, exactly. And a CPA would likely charge $1,000 and $1,500, something like that to help you with your taxes. For
really?
Yes.
Okay.
So as a retail investor, it is actually probably better if it's a corporation, just because you don't have to deal with the tax implications of being an owner in a partnership.
Unless it's LLC tax corporation.
Correct. If it's an LLC taxed as a corporation, then you only have to worry about stuff if you're getting a distribution. And in that case, it's actually well defined in like a tax software. Like you're just filling out one line of information in your your income section. I think it's like a 1099 or some
Sweet.
has a number after letter after that, but I can't remember.
Me neither.
From the perspective of the investor, we're telling them why they might want to be looking at corporation tax status for the investment that they're getting into for a little bit of ease. For an issuer, if you happen to be an issuer, a potential issuer, it's actually a better scenario as well to be taxed as a corporation because of the issue of K1s. If your investment ended up getting thousands of investors, there's not a lot of options out there for you to go and find help delivering those K1s, and it could be quite expensive. It is a tax form, so you have to do your taxes and then deliver a K1 to each owner. And I have seen services where they charge you like $2 per K1, and if you have 5,000 investors, you just paid $10,000 at the end of the year just for tax compliance.
Wow.
And you don't do that if you have a corporation. Now, if you had a ton of income as a corporation, you are now going to have to pay corporate tax. So it's a trade-off. If you're anticipating losses, though, no corporate taxation.
No corporate. Okay.
So those are the main items. But like going back to the documentation, when you're looking at it, so we just described what exists. What you want to verify in them are the things like, do they list other investors? Do you who do you want to be aware of existing in this capital structure? Does the company owe a bunch of money to somebody? That is outlined even in this like a waterfall distribution. So an LLC will typically indicate who gets money first, who gets money second, and it's not like by individual, it's typically by class of equity held.
You mentioned classes of equity earlier. Could you go into a little more detail for those of us who maybe don't know so much?
Yeah, a class of equity simply means ownership groups that have different rights. And so, or that were given at different times. And so with most companies, they all start out with common equity ownership. So, if you and your husband start some kind of climbing business, you would both become just common equity owners together in whatever proportion you want to split it. So that's common ownership.
Okay.
And then you can have preferred ownership, which is, I think, what everything else ends up being. And the reason why I say that is because any change from common is preferred. And that could be different. So some preferred could have voting rights or it could not. It could come with a preference on distribution or liquidation or not.
Okay.
It's negotiated typically.
Okay, so it's specific to the company?
Yeah, specific to the company and to the deal. And that's why there could be multiple. So like, let's say you had $5,000 and I had $1,000. And a company came and pitched us and said, I need your investment. Let's make a deal. And they looked at you and said, oh, you have $5,000. I want your investment more than they want my investment. And so they might offer you a preference that if we both invest, you would get paid out first if they end up in bankruptcy. And you would be able to negotiate for that because you have more money. And so they could create two classes of interest, one called Class M for Meg and one called Class F for Fred. And then the only difference could be that you have a preference. You get paid out first before me.
Okay.
As an example.
Once they're in preferred, does it just go class A, B, C, D, E, F?
They don't have to name it like that. No.
Okay.
They can name it whatever they want.
Class
really.
favorite investor.
Sure. Yeah. That's always what I negotiate for.
Sure. You gotta keep it interesting.
Yeah.
So
there actually is a favorable, not favorite, but there's a favored nation clause in some investments where, so like in a deal where you're getting an investment from somebody and they have lots of money, that could be something that they're asking for. They say, I want a most favored nation clause in my agreement.
Okay.
And it means that if that company goes and is negotiating deal terms with another person later on and offers them any kind of better term than the original investor who has the favored nation clause will also get that term.
Sweet.
So if I was smart, I would try to negotiate first with that company with my $1,000 and convince them to give me most favored nation clause.
I love that.
And then they would negotiate with you, and you would just have the clout to get better terms.
Yeah.
And I would just happen to get them with you.
Cool. I think that's great. I'm gonna stop this.
The content in this video is for informational purposes only and does not constitute financial, investment, or legal advice. Investing in securities involves risk, including the potential loss of your entire investment. Always conduct your own research and consult with a licensed financial advisor or legal professional before making any investment decisions. The opinions expressed in this video are those of the speaker and do not necessarily reflect the views of Ridge, Angel Funding, or VAS Portal.